Ben, could you walk me through a real situation where you sat down with some business partners and found this gap for them?
$1.8 million on each shareholder for immediately funding. So I asked them, where does $1.8 million come from if the earner passes away? And do you want to be business partners with their wife, their spouse? That's a no every single time.
See. So now, how do you actually go about solving this? I know you mentioned insurance. Like, does insurance fund a buy-sell agreement? Walk me through how you'd actually solve this.
Yeah, insurance does create the most cost-effective, most tax-efficient structure to do a transaction like this. If we're in this scenario where it's 50-50 ownership, partner A, partner B passes away, and now we have a spouse that owns the share. If insurance is involved, the insurance would pay to the corporation, which provides the necessary liquidity to complete the transaction. So when we do sit down, we'll have the discussion and figure out the adequate amount, which involves understanding what that business valuation is, current and projected. And we find life insurance policy, if there's two partners, two life insurance policies that are owned and paid for by the corporation. And again, if we are in the scenario where a buy-sell clause is enacted, the insurance provides that necessary funding.
Would the insurance also take care of the family of the deceased partner in this situation?
Yes, yeah, and quickly tax efficiently as well. So if you think of it, two insurance policies, life insurance policies on the lives of the business owners. If there's a payment benefit being paid into the corporation, that money is now intended to be given to the family of the deceased to compensate for that share. So now the family's made whole through the payment, and the business owner, the remaining business owner, retains 100% control of that company. There's no additional unneeded stress within that company. Employees are relaxed, other debt obligations aren't called into, and the business can continue as it's intended.
Interesting. And so, okay, let's say, I have a business, we have a partnership agreement, we want to get it funded. How would you go about figuring out the right amount of coverage? And how do you actually value the business for this purpose?
Yeah, so we'll work along with, if there's an accountant there, we'll work along with the accountant to figure out the exact current business valuation, which is just a mixture of earnings and assets on hand, as well as growth trajectory, and the ownership percentages that are there. So the example that we're using, it's very common, a 50-50 ownership structure. To keep the numbers nice and round, if it's worth $1 million and we're trying to create funding for that, 50-50 ownership, there would be two life insurance policies for $500,000 each, creating the necessary coverage.
And what does this actually cost? Like, say, I don't know, you have a 50-year-old business owner, and you mentioned the business is worth $1 million, so each partner needs about $500,000, I'm guessing, in term coverage. Like, could you give me a ballpark of how you would calculate the cost for something like this?
Yeah, so we would run the numbers based on the age of the individual. A lot of people do assume that the costs are much higher than they actually are. One thing I always say, this is a fraction of what it would be to obtain funding in a period like this. So for a 50-year-old, for a $500,000 policy, you'd be looking at about $140 a month for the necessary coverage, which again is significantly lower than trying to obtain a $500,000 loan last minute to provide the transaction.
Right. So I guess what you're saying is, for the cost of a gym membership, you could potentially avoid a six-figure problem down the line.
Yeah, no, it's in the grand scheme of things, absolutely.
All right. And now, what about the tax side of things? In Canada, how is this situation treated?
Yeah, so in Canada, there are very few financial tools that move money tax-free, and life insurance is one of them. So there's many tax advantages to structuring it this way, but essentially because we have the company owning and paying for a policy, if a death benefit does pay out, that benefit is tax-free to the company. So if we're using the $500,000 in the same example, $500,000 is deposited into that company without tax. And now we have the next step of the transaction, which is trying to move money out. As any business owner knows, moving money out of a corporation is a bit of a nightmare in terms of tax. But in this case, we have what's called a credit to the Capital Dividend Account. And that credit allows the money now to be transferred to the spouse to receive money for compensation for the share. As long as it was structured properly, again, no tax coming in and no tax going out. So it's just a tax-free transaction from start to finish.
Okay. And I guess for anyone who's not familiar with the Capital Dividend Account or CDA, could you explain that in a couple of sentences?
Yeah, essentially what the Capital Dividend Account does is so as money is deposited from an insurance transaction, it's a credit. It's an accounting, it's a notional account for the transaction to go through. So the money is now inside of that corporation, which allows, so if we use the example here, so $500,000 goes into the corporation, $500,000 is credited to the Capital Dividend Account, and a capital dividend is not taxed. So money is now removed from the corporation, completely tax-free.
Okay. So it's like it lets money go into the corporation and then come out without having to pay additional like income or dividend tax on that money.
Correct. If any business owner is aware of dividends, they know that they're paying tax on those dividends. The Capital Dividend Account is completely separate, where it does not involve tax. So from that transaction, that allows the money to flow through the corporation tax-free, all because we created the credit through the deposit of life insurance.
It's powerful. And we're going to do a whole episode on the CDA later, especially when it comes to Canadian tax planning. And I know a lot of business owners haven't heard of it, so stay tuned for that. Now, Ben, what's the difference between, say, a cross-purchase agreement and an entity purchase agreement when it comes to buy-sell funding? And does it really matter what type of agreement you go with?
Yeah, so we'll work with the lawyer or the existing agreement that's in place to figure out the best method of structuring the life insurance policies. But yeah, they can be owned, let's say the two partners can own insurance on each other. So the cross method where, so partner A owns a policy on partner B owns a policy on partner A, and provide the necessary funds to the surviving partner if something was to happen to the other. Or we can structure it simply as where the corporation owns the policy on each shareholder, and then the corporation is going to receive the funding and then complete the transaction based on that. So it depends on how your buy-sell is drawn up, will be how we design the best necessary funding method.
Okay, so it does depend a lot on the business situation, the partners, the corporate structure, and all of that. Is this something a business owner should figure out on their own, or do they need an advisor to help with this?
Yes, yeah, they do need an advisor to, one, figure out the correct value that the policy should be, and two, working with an advisor to figure out the best structure of that policy. Because like I say, it's very tax efficient as long as it's structured properly. And by going through the proper steps with us, we can ensure that it is set up properly from the very start. Take an hour to figure it out, and you don't have to think about it ever again.
Right. So now let's zoom out for a second. Say I'm a business owner and I just realized I need buy-sell funding. What else should I be looking at that I'm also probably missing, perhaps even on the insurance side?
Yep. So when we're doing our, let's call it a review with the client, one of the things that we do go through is the buy-sell. Is it there and is it funded? The second part of it is key person insurance. It's something that is also overlooked quite often. And this doesn't necessarily have to be insurance on the shareholders themselves. This could be an individual within the company that is extremely important piece to that company. Again, key person. So without that person around, that business is going to suffer significantly. The example I use quite often is the number one sales producer within the company. Let's say if we have one person making up 60% of sales for that company, that's significant revenue. Without that person, any business owner knows that they're in pretty big trouble in the short term if that person was no longer around. Same concept, using life insurance to replace the financial impact that they would have, keeps everything stress-free within the business, and allows it to continue on while they have the, let's say, the runway to sort things out.
Got it. Yeah, key person insurance. I can definitely see the value there, especially if you have important employees or personnel that would have an impact for you or your business. Are there any other types of insurance a business owner should be considering?
Yeah, and there's business overhead, but also, and that has to do with, because we can come across a scenario where disability comes into question, right? So it's easy to consider death, the certainty of it, and the definition of it. However, disability does get to a bit more complex in terms of the severity of it. Are they able to return to work? Does it trigger the buy-sell? But example I use day to day is the proverbial bus comes by, and we can understand what happens if we pass away. But what about the scenario where we're faced with a significant disability and the business partner is no longer able to perform the duties that they once were? Does that trigger a buy-sell? And if it does trigger the buy-sell, how is that going to be funded? So again, instead of life insurance, we can look at disability insurance to provide the same type of funding, just through a disability policy.
Right. And we don't like to think about it, but the chance of having a disability occur in your lifetime, I'd say, is much higher than a lot of people expect.
Yeah, I think 4 times for the average working age. So it's something that usually is more overlooked than the life insurance, but it's something that we do need to address and just simply understand the risk that's there. And are we able to provide insurance as a means to cover that risk?
Great. Now, what about the solo business owner watching this who maybe doesn't have a partner? Is this episode or anything we've mentioned on the insurance side still relevant to them?
A business owner, especially if it's an incorporated business, they have a share attached to it. That share has tax attached to it. They have assets within the company. And also they have, let's say, an obligation to continue the company past them. So if it's a intergenerational type of business where you intend to have, let's say, a child take over that company, if you were to pass away prematurely, there's significant concern issues created by that. And insurance is a very tax efficient way to provide necessary liquidity to pay for taxes that might arise through the estate and to allow that business to continue.
Yeah, no, that's a great point, especially thinking about succession planning and insurance playing a role in that. But again, that's a whole other conversation that we'll get into in a future episode. So yeah, I think we've covered buy-sell agreements and why they're important as a funding mechanism for business partnerships. Ben, could you walk me through a real situation? You don't necessarily have to name specific names, but where you sat down with some business partners and found this gap for them?
Yeah, happy to take it through, like start from finish. There was pretty recently, came across, we were working with 2 business partners that own and operate the company, been around for 14 years, have seen significant growth as of recently. And we're originally discussing corporate investments. That's why we were brought in. And a part of the process, we do ask these questions just to make sure that we're not missing anything and that the buy-sell does come up. But yeah, so 2 partners in their 40s, business was valued at, I think, $3.8 million. And so that means it's 50-50 share. So just under $2 million each share, we'll call it. Going around initial discussions, this did come up. And it happens every time where they don't want to talk about it. They assume that they're covered. And in this case, even they had coverage, personal coverage in place, which is also really common to bring up. And no, I have insurance policies. We're fine. We don't need to talk about it. But in reality, those personal insurance policies were designed for something completely different. Those personal insurance policies were designed for covering personal debt and income replacement for the family. It doesn't actually do anything for the other shareholder of that business. So what we did was we uncovered the risk, and what that was, $1.8 million on each shareholder for immediately funding. So I asked them, where does $1.8 million come from if the owner passes away? And do you want to be business partners with their wife, their spouse? That's a no every single time. So all we did there was ran the numbers and created 2 term 20 insurance policies on each shareholder for a very low cost. I think it was under $200 for each policy. So we took care of a $2 million risk on each partner, guaranteed it for 20 years. And within those policies, it guaranteed a clean transaction that fit within their buy-sell to provide the funding necessary to quickly pay the spouse and continue operating the business as normal.
Yeah, that's powerful. Again, for the cost of a gym membership, they're able to cover that. But I'm also curious, when you initially showed them that number, the moment you said, hey, you're each going to be liable for $1.8 million, what type of reaction do you usually get then?
Usually, when we are able to show it, and you can't argue with a number when it's there, it's sort of confusion because, again, most would assume that this has been taken care of with these legal documents. And then it's relief once the solution is not complicated. Not addressing it is extremely complicated. And I want to basically make that point of once we're there, we can solve it within an hour. And then when you compare it to what happens without, no one wants to be in that scenario. So understanding that it can be addressed for a very low cost, for a guaranteed amount, for a guaranteed time period is a huge relief for any business owner.